Good morning from wherever you are joining us from. Welcome to our Friday pension clinic. Sorry for the technical hitch that we've been experiencing. Yeah, I know time is a bit spent, but we're here and we have a big team from Octagon, and we are ready to give you all the pension insights that you need as you prepare for your retirement. My name is Eve. Eve Wangare. I'm from the marketing department, and with us we have our presenter today. Her name is Crescentia Ododa. She is a senior business development manager, and we also have Nafula Rogata. She is the one who has been keeping contact with you guys. We also have Michael Common. He's our senior pension administrator. We also have David Songero, our GM for insurance, and we also have our manager for customer service, Monica Shiwatso. Feel very much welcome, and feel free to use the Q&A section for any question that you may be having throughout the session. You can also put up your hand if you need to talk, or if you need the moderator to notice you have an issue, or if you want us to address the specific question that you might need answered. And then we also have the slides from our presenter. These ones will be shared after the session, and we are happy to have you today. Feel much welcome, and feel free to go to ask anything that you might need clarification on. And for the next 1 hour, I'll handle it over to our main speaker of the day, Crescentia Ododa. Over to you. Able to address the meeting. Crescentia, kindly come in.
Thank you, Eve. Can you hear me now?
Yes, I can hear you loud and clear.
Awesome. Okay.
Right.
Well, Eve has taken us through a majority of it, and as earlier mentioned, our vision on this is to enrich lives through innovative financial services and solutions, and this is done through safeguarding the financial future of our customers through lifelong learning, risk management, and retirement solutions. Our core values is customer intimacy. We would like to know how our customers are doing and how we can always serve them better. We are very keen on this, and as well to listen to their needs so that we can give customer-centric solutions. We have high regard for integrity. This is in how we carry ourselves out in interacting with our customers and with each other as colleagues. We also respect each other and respect our clients as well. And we are big on innovation. We believe in through innovation, services can be offered efficiently and effectively. I'd like to take you through Octagon's journey. This from 2007 when Octagon was incorporated. Through the years, we have seen other services coming on board, like the trustee services management. This is in 2008. The umbrella fund, this is a retail product which was established in 2009. 2010, we had our insurance brokerage incorporated. In 2013, we ventured into our neighboring country, Uganda, and in 2017, we opened our office in Zambia. In between, we established the training and as well set up a college in 2017. In 2019, we launched our Mobikeza, which is our mobile app-based product for saving for pension, and allows members to save on a daily basis, on a monthly basis. It is often as and when available. Therefore, they can guarantee their financial security in their retirement. Octagon has won a number of awards over the years. And through this, I want to believe Octagon is a house name as far as excellence is concerned. I'd like to take you briefly through our team. Our chairman for the board is Richard Omwela, and under him there are a number of non-executive directors. As well, we have our group CEO sitting in the board, and he is an executive director. We also have other members of management now reporting to our group CEO. What we'll be discussing today, and what I'd like you to know, is that Octagon Insurance Brokers is licensed to broker for all classes of insurance. That is basically both general and life. And with the Octagon is the insurance brokerage is also regulated by IRA, and as well we have put in place the right expertise and systems to support all clients with their diverse needs. In terms of covers, there's fire and special perils, fire consequential loss, burglary, all risk, goods in transit, together with marine cover, fidelity guarantee, professional indemnity, motor insurance, public liability, house owners and householders policy, personal accident, WIBA, machinery breakdown, credit life, Octagon last respect, that is the easy cover. There's also staff medical scheme for employees in different organizations, and group life cover. Today, I'd like to take us through retirement. And one of the things I'll ask, why do employers provide for retirement benefits for the employees? One of the reasons is to maintain standards of living even at retirement, and then as well to incorporate the saving culture for their employees as they are working. There are also tax advantages. This is in terms of the registered fund that allows members to enjoy a tax advantage through when you save any amount to the up to capped at 20,000, payee tax is actually not levied on any amount below that. Then above that, tax will be paid, and through that is the tax advantage, which is good to actually enjoy as employees. The employer also enjoys tax advantages when they save for pension for their members. Employees who actually have retirement savings have been shown to live longer in old age. That is because they have something to look forward to. Then there's the mortgage guarantees. This is in terms of, we have seen the government allowing members to access mortgage through their pension. And of course, there's now the fallback on job loss. We've seen a lot has happened. COVID has brought a lot of insecurity, and together with actually in terms of job security and financial losses. Through this, if there's pension that had been saved over the member's working life, there's often something to fall back on, of which they can always access a particular amount that is even before they are 50 years old. There are three types of pension. There's the state, there's the occupational, and there's the personal. When you talk about the state pension, this is the NSSF. Occupational scheme is when an employer actually sets up a pension scheme for the employees and also contributes therein. Personal pension is where an individual will choose to save for their own pension as individuals, and oftentimes those who are not in employment save for their pension through personal. Then pension can either be defined contribution or defined benefits. We are seeing a lot of movement from defined benefit schemes into defined contributions. Then the fund can also be a pension fund or a provident fund. And the difference between the two is often at retirement, how somebody accesses the benefits. On a pension fund, you will access a third as a lump sum and 2/3 will be used to purchase an annuity or an income drawdown, while a provident fund, the whole amount can be accessed as a lump sum. How a retirement benefit scheme is formed. It's normally formed under a separate trust, and then it's actually an irrevocable trust whereby you cannot, it is not at the discretion of the employer to set it up today and tomorrow they just withdraw it. Once it is set up, it is now registered with RBA and it becomes a separate entity from the sponsor. Then trustees are appointed to look after the assets for the benefit of the members and beneficiaries, and the scheme must be regulated by RBA and KRA, that is the Retirement Benefit Authority and Kenya Revenue Authority. The purpose of the scheme is often to cover for three great issues to ensure its members and beneficiaries are covered against economic consequences. And this is in terms of old age. The older you get, energy goes down, sources of income also decrease, your dependency increases as well. At such a point, we want to believe that when you are working while younger, you work twice as hard, such that you actually earn what you earn on a month-on-month basis, and then you put aside a particular amount that will take care of you in old age. Therefore, to safeguard old age poverty, pension funds actually come to play. There's also ill health. Excuse me. Should a member be determined to be not in a position to work due to a critical illness, they can actually access their benefits and it can come through for them at that particular time. As well, in terms of death, should a member pass on, the pension benefits are for the benefit of the saving member and for the beneficiaries. At such a point, in the unfortunate event of death, the benefits will actually be paid to the nominated beneficiaries so that they are actually cushioned by the loss of their loved one at such a point. What actually forms your pension fund? It's often the contributions from the employer, contributions from the members, income from the investment of assets. That means as you continue contributing, the funds are invested, and every year a particular return will be declared, and that will be credited into the members' accounts. As well, we have the transfers from other schemes. You could have worked previously with other employers, and as you progress in your career, you transfer with your pension funds from previous employers to boost your current fund. And the contributions will differ. Different organizations have different contribution rates, whereby the employer, the organization will contribute a particular percentage and the member contributes a particular percentage. This is just in an ideal setup where an organization will contribute 12.5 and 7.5 of the member's basic salary to give you 20% of your contribution, 20% as contribution towards pension. While this depends on an individual, when they will look at it and say, I will actually be retiring to about 20% monthly income on my pension. Is this adequate or not? Such a point will lead you to make a decision whether an additional voluntary contribution is important or not. Should it be important? If you see that 20% of my basic will not cater for all my needs on retirement, it is advisable to do additional voluntary contribution that will actually boost your fund. There's normally no limit for the additional voluntary contribution as long as the anti-money laundering guidelines are adhered to and the KYC policies are also applied. The Know Your Customer policies are also applied. Normal retirement age for most schemes is normally 60 years. Early retirement age is 50 years. This is based on the Kenyan regulation whereby anyone at 50 years can retire. Therefore, that is the earliest a member can retire. While most people have normal retirement, most schemes have normal retirement age at 60 years. Retirement is not expiry. You can be retired but not tired. Neither are you expired. It's good to look forward to. It's good to look forward to retirement. This is in terms of accessing funds. whereby at the point of retirement, members can access, this is when you are below the retirement age, a member can access 100% of the employee benefits and 50% of the employer benefits, and the remaining 50% is deferred to be accessed at retirement age. When the member is already retired, that is from any age from 50 years, they withdraw 100% of their savings plus interest thereon, and the benefits will be paid once the member leaves the employer. And on that note, there's normally a pension and a provident. If the scheme is a provident fund, the member will access 100% of their benefit. If the scheme is a pension fund, the member will withdraw a third of it as a lump sum, and 2/3 will be used to purchase an annuity or an income drawdown. Annuity is actually purchased from an insurance company of the member's choice, while an income drawdown is purchased from schemes that engage in financial, in asset management. I will get into income drawdown and annuity a bit later on. I want to confirm, is there any question at the moment? If you could guide me, is there any question that I need to tackle before we proceed?
Thank you, Chris-Ansha, for so far, so good. Yeah, we have 3 questions from one of our dear members. His name is Benson John Mwangi. He's asking, can I give an alternate? Sorry. All right. He's asking, how do I calculate the lump sum I am entitled to after retirement?
Is it from a pension or provident? I'll give both scenarios. The lump sum for a pension, if it's a provident fund, I'll start with the provident one because it's the easier one. For a provident fund will be all contributions from both the employer and the employee, any transfers that have come in the course of service, all the interest that have been earned in the duration of the fund, and then I've talked of transfers and interest. Yes, the whole of it becomes the lump sum that can be withdrawn.
All right. Thank you for that. He also has another question. He's asking, what of the monthly pension? How do I calculate it?
Okay. Monthly pension, that is in case of a pension. Now, once you've determined your whole fund, as I've mentioned what the whole fund will comprise of, in terms of pension, 1/3 of it, that is even before taxation, 1/3 of it will be given out as a tax lump sum, and then the 2/3 of it will be taken in as pension in terms of annuity or an income drawdown. I'd like to allow me to get into that just a few slides after this, whereby I will now talk about the annuity and income drawdown, and as well assist in determining around what amount a member can anticipate to get. Okay. There are other times that a member can withdraw their full benefits before retirement, and this is on ill health, whereby the member is proven not to be in their capacity to be off. You're not in a position to continue with your day-to-day job because of probably a critical illness or an accident or a particular situation. Different positions apply to different people. Like I can give an example. If my job is, I work in the call center and I have an ear issue whereby I can no longer receive or answer calls, that is an ill health case, and of which will actually affect my day-to-day job, and they can actually claim a benefit. In the same scenario, if I am at that position where I have an ear issue and probably my job involves typing, which is the hands, that is not an ill health condition. Therefore, you're still in a position to be gainfully employed. Therefore, ill health conditions varies from one person to another depending on their job, and even generally, if my job demands that I stand daily and my leg probably has an issue in such a way I cannot be gainfully employed, then that will be an ill health issue. As well, if probably I have I'm in a critical condition. I'll give an example as cancer, and I'm tied up in a hospital, or actually admitted in a hospital for long. I cannot be in the office. That is an ill health condition. And in such cases, a member can withdraw all their benefits to assist them at such a point of need. As well, a member, the beneficiaries can withdraw the member's fund credit or fund value upon the member's death. And they can either, if the members are juniors, they can transfer this into a trust fund for their management and to ensure, and as well to assist in upkeep. On the other hand, if they are of majority age, they can be given the money in cash. When a member is leaving the country, this is on permanent immigration with no intention of returning back to Kenya, they can access their whole fund credit. And then as well, a whole fund credit can be transferred to another registered retirement benefit scheme upon request. This is in terms of governance, how a scheme operates. There's the scheme, and the scheme belongs to the members. And because the members are so many, the members will not, oftentimes they will not agree on how to manage the fund. They will not agree on where to invest. They'll not agree on who is holding what money. They'll not, it is normally not easy when a number of people are controlling one thing. Therefore, in such a case, there'll be a representation from them, and this will form the trustees. And the trustees will ensure that the assets of the scheme are safeguarded and utilized according to the rules as per RBA. And in such a case, the trustees are allowed to delegate particular functions, and this can be in terms of investment manager. And the role of the investment manager is to ensure good returns into the fund. The administrator's job is to ensure that the records are well kept in terms of member details and contribution details. The custodian is to keep the funds of the scheme in safe custody and to ensure that they are well protected. The good thing is that funds of the scheme normally are held in nominee accounts and not, and therefore do not form part of the bank assets or liabilities in such a case where such money is not lent out to a normal bank customer. Hope that is clear. We have discussed that. In terms of payment processing, the process takes a maximum of 30 days. I spoke of additional voluntary contribution, and this is normally I find it's a very important slide for us to note. And I want to look at 2000. Members, what can 2000 do to you? Or how often, when you go into the supermarket and shop for 2000, what do you come out with? Do you leave having bought everything you desired, or you're still thinking at such a point that you wish you had more money? Is 2000 sufficient in the day-to-day? Unfortunately not. It is something that I have seen many people spend 2000 in a weekend. This is in terms of food, could even be in terms of drinks, could even be in terms of impulse buying. And this is money that could probably just disappear like that in a weekend. But what is 2000 as far as your pension is concerned? Let's say you start your first job and you're contributing 2000 as an additional voluntary contribution. I want us to look at the magic of this. And let's assume an escalation rate of 10%, whereby every year with every salary increment, you increase the initial FVC of 2000 by only 10% of it. Meaning the next year, 10% of it will be 200. The next year you will do 2200. Then the other year you continue increasing it as you go on. And you can just look, we'll take in terms of principal, this is the first row whereby you have the principal in 5 years. If you're just doing 2000 and you escalate it with 10% every year in terms of contribution without interest, will be 146,522. You can imagine this is money that you can easily, if you're a lady, this is money you walk across the street and you buy a pair of shoes. If you're a guy, this is the money you say kwa bili yangu, and members and your friends are entertained, and it ends there. As we had assumed this was your first employer, and first jobs come at around when you're 25. By the time you're retiring, you are already, let's say 50. Therefore, in 25 years, you'll have worked for 25 years, and therefore you are retiring at 50 years. 50 years, if you're saving only 2,000 with such an escalation, you will have saved 2.3 million. If this money is earning the average or the moderate return of 8% in 25 years, you will have 5.1 this figure here. If it's highly invested in high return vehicles, it will give you 8.2 million. You can look at the value of 2,000 and the effect of it. I think once you look at it in such a table, you actually realize 2,000 is not to be dismissed as we often dismiss it when we're doing other things. Therefore, this is to encourage us, look at what you're retiring with, where are you at the moment, where would you like to retire at, and what can you do about it now, and what's the impact of that little that you can put aside towards retirement. In terms of taxation, I had mentioned that contributions are tax deductible. This is up to 20,000 monthly, and investment income may be tax-free. This is generally on the registered fund, whereby contributions up to 20,000 can be tax-free. And then at such a point where you're retiring, part of it will be taxed. This is the amounts that have not been taxed at contribution and investment will now be taxed at the point of accessing it. But the good news is that the tax bands at that point are much friendlier than what you would have been subjected to at payee. And then as well, if you actually take your retirement funds above 65 years, you're likely to take it at tax-free. Elimination of Beneficiary. This is a very important document that you're required by law to fill as and when circumstances change. This is in terms of you start contributing in a pension before you are married. You get married, you're supposed to update it. You get a new baby, you're supposed to update it. And in the unfortunate event of one passing on, you're supposed to update it accordingly. This document guides trustees in allocating your benefits in the unfortunate event of death. And it's very important because it will avoid unnecessary delays in paying out your benefits. This is because pension benefits normally do not form part of a member's estate. Therefore, this document will give you peace of mind if it's updated well and in time, so that the right benefits goes to the right beneficiaries. And that's in terms of what are your rights and obligations as a member is to choose your benefits, how your benefits are treated upon exit. Do you want to access it? Do you want to transfer it? What do you want to do? Do you want to defer it? You get to choose. And then it's your right to receive benefits within 30 days after exit. I want to believe those who are at Octagon will tell you that we do this in such a shorter period. 30 days is by law, but we ensure that within at most by 14 days, a member has been paid. Then as well, it's your right to know that there's a non-assignment of benefits. Should you be in a position where, let's say, you're in a circle at work, or you probably have an salary advance, and then you exit, there's no way your pension benefit can be used to settle any other obligations. It's your right to nominate your beneficiaries. It's your right to participate in electing trustees. It's also your right to be invited and to attend AGMs, and it's also your right to receive benefit statements. By law, this should be given annually after interest allocation. But the good thing at Octagon, we allow you to view your statement as and when you require. This is through our Octagon portal. What is an annuity? You told me there's a question on it. I'd like to take you through now annuities. And this is a specified income payable at stated intervals for a fixed or a contingent period, often during the recipient's life, in consideration of a stipulated premium paid either in prior installment payments or in a single payment. What this means is that at the point of accessing your benefits, you take a particular amount and transfer it to an insurance. When an insurance receives that money, they now get to calculate to you. I'd like to give you an example. This is an example of a quotation, an annuity quotation, whereby the principal amount, as you can see, is 2 million. Gender is important, as we're told here, is a male. And then we have the year of birth. Once you give the 2 million, this is normally called the purchase price, and then you get to see the amount that the member is likely to receive over that duration. We normally have terms like escalation and guarantee period. I'll go through this shortly, but you can see with the 0% escalation, the amounts possible is 22,000, then there's 21,000, 20,000, depending on the guarantee period. Then over, as you go down in terms of escalation, the amounts tend to go lower. I can take you through what an escalation and a guarantee period is. A guarantee period, first of all, when you purchase an annuity, I'd like to be clear that the annuity will be paid for the rest of the member's life. If you purchase, let's say if you purchase when you're 50 years, you'll be paid an annuity for the rest of your life, be it an additional 50 years, you are sure that the amount, the contract you got into will be a life contract. Therefore, the one thing you need to be sure, I normally say purchasing an annuity is normally not an emergency. It's good to get as much information as you need because you're getting into a life contract. It's almost like a marriage. Before you get into a marriage, you have to be sure that you're getting in with the right person, because oftentimes the exit clause is not there. Same to the annuity. In terms of guarantee period, the guarantee period affects your beneficiaries, not the member himself who has purchased. When you see a 0-year guarantee, there's no guarantee that should the member pass on, benefits will be paid to the beneficiaries. The 5-year guarantee, this 5-year guarantee guarantees that should the member pass on before 5 years, the difference of that duration, let's say the member has lived for 3 years and the guarantee period they picked was 5 years. If you've lived for 3 years, the guarantee period, the difference is now 2 years. For those 2 years, whatever the member would have earned is now payable to the beneficiaries. If a member picks 10 years and the member lives for 5 years, the difference of that will be 5 years, and that whatever the member would have earned in 5 years is paid to the beneficiaries. On the other side, if the member picks 5 years guarantee period and the member lives for 6 years, he would have exhausted his guarantee period, meaning there'll be nothing payable to the beneficiaries. Same to the 10-year, if you live longer than the guarantee period, there's nothing payable to the beneficiaries. If you take a 0 years guarantee, even if you have been paid only for 1 month, there's no benefit payable to the beneficiaries. If you look at it, the higher the risk, the higher the amount that is payable to the member. That is at 0 years where there's no guarantee, the member is earning at 22,000. At 5 years, where the risk is only for 5 years, the member is earning at 21,000. 10 years, the period has been elongated and the risk and the amount is payable for 20 years. For somebody to consider the right guarantee period, you need to look at the age of your youngest beneficiary. If your youngest beneficiary has 5 years to independence, it's okay to pick 5 years. If your youngest beneficiary has 20 years to be independent, it's better to pick the 10 years guarantee period. If a person, which is highly unlikely, has no beneficiary, it's okay to pick the 0 years guarantee. In terms of escalation, this means the percentage that the monthly payment will be increasing at annually. If you take 0 years, what you have started with is what you will close with, is what you will earn for the rest of your life. If you take 2%, meaning that every year, the amount you are starting with, let's assume this guarantee of 0 years, you start at 16,637. Every year, this amount will increase by 2%. If you take an escalation of 3%, you start at 13,180, and every year this amount will increase by this particular percentage. For you to look at it in terms of, if you look at it, how the payouts translate downwards in terms of guarantee period, you will see there's a big difference. Almost of this is 22 and 16, this is almost 6,000. 16 and 13, this is almost 3,000. But across here, there's hardly any difference. You can look at securing your benefit with 10 years and you're getting 20 years, as opposed to no guarantee and 22 years. Therefore, it's normally advisable to pick the longest guarantee possible for the member. This is in line with the age of the youngest beneficiary. And then probably as well, you can look at this difference in terms of escalation. As well, at the point of somebody accessing an annuity, the member will be guided adequately. One of the things you will discuss is you actually even have a session where you can be calculated to, whereby if you start at 16,000 with an escalation of 2%, how many years will it take you to reach at 22,000? And with such a calculation, you get to see, are you better off or not? Are you better off waiting for maybe, let's say, 5 years to reach at 22,000, and then thereafter you surpass this amount and continue surpassing it annually as it increases by 2%? Or are you better off saying, I'm better off with my 6,000 difference right now, so that I start at 22,000 and never anticipate a 2% increment? I wanted to mention in terms of gender, it's very important. Statistics indicate that men tend to live a shorter period than ladies. I don't know if you've men tend to live, women generally tend to live longer than ladies. Therefore, for such a quotation, if the gender was female, the amount would have been slightly lower. This is because it is anticipated that the lady will live much longer than the male. Then as well, in terms of date of birth, the older you are, the amounts, the payouts tend to be higher than the younger you are. This is because the older you are, there are high chances of mortality as compared to when you are much younger. Keep that in thought. I will bring it to further discussion when we discuss the income drawdown. Characteristics of an annuity. So we'll say they can either be escalating or level depending on a member's choice, and they usually start on a lower rate than the level. Escalating annuities start on a lower rate than the level annuity. And a member enjoys a tax relief of up to 25,000 per month, and at the time of purchase, they are issued by the member enjoys 25,000 in terms of tax relief monthly. And annuities are often actually issued by life insurance companies, and they provide they're a source of income that you cannot outlive. Question on annuity before I get to income drawdown.
Hi, Chris. Thank you for your comprehensive coverage. Yeah, we have one question from Franklin Manduku. Yeah, he's asking, how is undeclared interest supposed to be treated when you have an employee withdrawing their funds before declaration? When should it be paid to the member since they have earned it?
Undeclared interest. Okay, I'll answer that at the moment. When a member, how the pension fund runs is that from January to if it's a December year end, January to December, contributions are received, and on a month-to-month basis, the funds are invested, and therefore they gain interest as they continue. But this interest is not determined on a month-to-month basis for allocation, for immediate allocation. The fund will continue earning interest until December. Then December, the books are closed and an audit is carried out. Once an audit is carried out, all this is determined, and the auditor will determine what is the interest that has been earned in terms of amount. they will say, let's say, for example, if the fund was 1 million and it has earned interest of 500,000. Let's say 500,000, okay? This 500,000 will now be determined as interest, and of course to be separated as registered and unregistered. That's for accounting purposes. And then thereafter, this is now presented to the trustees at the point of audit presentation and signing of financials. At such a point, the trustees will look at the interest, and oftentimes, actually these days, there's no longer, there are very few cases of putting out reserve. Therefore, in often cases, the interest and will be fully allocated to the scheme or to the members' individual accounts. This is now determined in terms of the percentage. Let's say, for example, this 500,000 interest is now 10%. So each fund will earn, each member's account will earn 10%. The whole audit and interest allocation and everything happens in the next year, in the subsequent year. Audit begins in January, ends 31st of March. Accounts are signed at that point. Sorry? Did I hear you? Can you hear me? Can anyone hear me?
Yes, Chrysantia, we can get you. We are hearing you.
Okay. Okay, thank you. When audit is closed in around March, interest allocation is done in April and May thereabout. Then thereafter, AGMs are held. But there are members whose money was in the fund from January to probably in the course of the year, could even be there till December, but they chose to access their benefits in January, even before audit is closed. What happens to such members? This is whereby the declared interest is not yet credited into the members' accounts. So when they access their benefit, they will access what was already in their accounts. Interest will still be loaded in their accounts thereafter, around April, May. And that interest is what we call shortfall interest. This is interest that the member fell short of at the point of accessing it. They are still entitled to it, and it is still payable to them. If the member accessed the full fund, this is in terms of retirement or ill health or death or immigration or even transferring their benefits, that interest will be sent where, or will be paid to the previous account where it was initially paid. Let's say, for example, if it is in terms of retirement and the member accessed the whole benefit, the member is actually now, what will happen around June, all pension companies actually go into the period of paying out shortfall interest. At such a point, if you retired, your money, your shortfall interest will now be credited into the account that it was paid. If it was in terms of an annuity purchase, at such a point, you'll be contacted and asked, do you want to boost your annuity, or do you want to be paid out as a cash? If it was also in terms of income drawdown, the same will be asked to you. If you are transferring your benefit, the fund will be automatically transferred to the destination registered retirement benefit scheme. If it was in terms of death benefits and there's a trust that was open, the benefits will be transferred to the trust. If it was in terms of immigration, the money will be paid to the previous account that the first installment was paid into. Therefore, at such a point, the member will be paid what is due to them, although it comes at around June. This is because up to March, audit happens and the accounts are adopted. In April, interest is now declared and crediting of members' interest happens at such a point. Then in May, there's often the member statements, disbursement or accessing at such a point. Then now in June, the administrator gets on in terms of paying off shortfall interest. Have I answered the question? The member that raised it, you can just probably chat in the Q&A for Eve to note and guide me. As I wait for that confirmation, is there another question in the chat?
Okay, this one I think is more directed to our administration department. An anonymous member is asking, when I download my statement for last year, I only see my total contributions for the year. Where do I see my annual returns?
Okay, at such a point, I think we'll give you an email where that can be directed to, you can be guided on how to go about it. Unfortunately, part of this presentation will not involve our portal access. Therefore, for that particular member, I will request if they can get our admin email address, whereby we can actually guide on that at a departmental level.
All right. For the member who has asked that question, I am replying to your chat with an email address, support@octagonafrica.com. We will be able to see your query and we'll be able to support you from that end. To the rest of our members, thank you so much for your continued attention. I'm still encouraging you to engage us with within the live event Q&A section. All your questions will be answered within the session as we progress. So kindly feel free, do not leave any stone unturned. Any question is welcome, and you are highly encouraged to just put it out there so that our speaker of the day can be able to answer your question. Over to you, Crescentia.
Thank you, Eve. Okay, I'll look at the income drawdown fund, which is let me say a sister product to the annuity that I've just discussed a few minutes ago. I'd like to start from its history. Previously, RBA required that all 2/3 benefits, or these benefits in terms of lump sum payments towards a pension sort of payment, were done through an annuity. And over and above, it was seen that this was not a sufficient solution to all members, and the members that felt they were not okay with an income drawdown were mostly members who had really large amounts of money. And with that, let me take you back to this annuity quotation. Let's say you have, in terms of purchase price, you have 50 million. 50 million and the guarantee period is 10 years. When you look at this annuity, in terms of payment, the higher payment is like 1% of the fund. 1% of the fund, that is 2 million, around 20,000, okay? So let's say you have 50 million, and this is around 50,000 monthly if it's an annuity, because you will now get around 1% of it. And if you're accessing 50,000 monthly with a guarantee period of 10 years, if you do 50,000 times 12 times 10, 600. If you're taking 50 million monthly, 50,000 monthly for a year, that is like 600,000. If you do it for 10 years, that is 6 million. And with the guarantee period of 10 years, you are sure only 6 million. Should anything happen, the guarantee periods are a bit limited, although it goes up to 20 years. So even say it's 20 years. If you put it at 20 years, this is around maybe 12 million. You have guaranteed 12 million will be paid out to your beneficiaries should anything happen to you. But what you already invested as purchase price is 50 million. Therefore, the difference, 50 million to 12 million, comes to around, is it 38? Yeah, 38. You have 38 million that you're not sure should anything happen, what will be paid to your beneficiaries. Due to issues of guarantee period limitations, and then as well, others will think like, first of all, the first issue was guarantee period limitation. Others will feel like, I'm giving you 50 million, but you're dictating what amount you're giving me. But for me, I would want to give you 50 million, probably access above the 50,000 you want to give me. I'd like to access 100,000. Therefore, one was guarantee period limitation. Another one was what amount can you access monthly. members felt that they needed to determine what amount is okay for them. Could be either higher or less. You're probably given 2 million and the dictation is you're taking 22,000. You probably need less of it. Let's say you even need 10,000. If I need 10,000, what's its effect in there? What's the effect of my money in the fund? So with such limitations, and then there was also others felt like, I give you 2 million, there's a lot of investment you are doing. At the end of it all, you're probably earning more than I should have probably gained. And they felt that the risk was better if transferred to them so that they can feel whatever returns they get is credited into their accounts and they get to enjoy. And oftentimes it has been seen members even having income drawdowns get to only draw down the interest element and not even the capital that they initiated the drawdown with. So with these challenges, in 2018, it was allowed that income drawdown is actually an alternative to annuity. And therefore, we've seen members venturing into income drawdown. This is because of the flexibilities that actually come with it. With that, I want to confirm that it is an option backed by RBA, and members have actually delved into it. The income is not guaranteed, but is entirely dependent on the performance of the underlying investments. As opposed to an annuity, where you are told you'll get, for example, 1% of the fund for the rest of your life. And whatever interest is earned or not, you will never know, you will never be part of it. In this other point, you put your money in an investment fund and it earns an income. And this income is based on market performance or underlying investments. The good thing is that these investments are quite conservative. And being quite conservative, they are very low risk. Being low risk, the returns are also not as high. They are low, let me say low returns because of the risk element. For somebody giving you their money at retirement, this is money they have worked for in their course of their employment. And in often cases, they have no plan B, plan C. And in such a case, it is not wise to put it in high risk investments so that you get a high return. The risk is too high just for the sake of a return. That is why it is invested in conservative tools. And these are often in terms of bonds and government papers, the government bonds and bids. And in such a case, the returns are quite conservative, averaging to 10%. If you're getting a return of 10%, even if you're drawing down, this is still something that is coming into your fund and that's allowing you to draw from it. Then the higher your amount, 10% on 2 million and 10% on 50 million, there's a big difference about it. Okay, so with that, I'd like to confirm that investment income is not guaranteed. This is because such investments are done on conservative tools to ensure capital preservation. Why members have loved income drawdown? This is because of the flexibility it gives in terms of investment choice, frequency of drawing down, timing and amount of income withdrawals. What I mean through this is that whatever money that you give out as a lump sum for an income drawdown, it is invested and you get to choose. We have members who are quite young. Let me say people retire from as early as 50 years. That is still young as far as retirement is concerned. This is in comparison to different professions retiring at different ages, like we see the lawyer, the advocates, professors retiring from around 75 years. A 75-year-old and a 50-year-old, the investment profile is totally different. And therefore, you will see a 50-year-old actually choosing a bit of, will actually do an investment, a mix, will put in a little bit of equity or stock market investment, and then as well, the bulk of it doing as well the government papers. So the investment choice differs depending on age and investment or risk appetite as well. In terms of frequency, timing and amount of income withdrawals. Frequency is, you can say, I would want to be drawing my amount once annually. I would like to be drawing it quarterly. I would like to be drawing it twice annually. So you get to choose the frequency, and you can also draw it monthly. Timing, you also get to choose. If it's timing, I'll want mine on the 5th, I want mine on the 10th, I want mine. You get to choose which date works for you. Then the amount you can also choose, because you are not tied to, you must access the 1% of it. You're allowed to access from 1% to 15% of your fund for the whole per annum, but now broken down to the number of frequencies you'd like to withdraw. Okay, in selecting an income drawdown arrangement, members assume the investment and longevity risk. At such a point, when you are choosing which option to go, whether income drawdown or whether to go annuity, you look at the investment and longevity risk. Investment will look at the amount. Imagine if you're putting an income drawdown of, let's say, $500,000. $500,000, if you're drawing from it, if it is an annuity, this will probably, this should give you around 5,000. This will give you around 5,000. If it is, if you're putting, let's say, an amount of 50 million, this should probably give you around 50,000. Let's say 50,000. Okay. How if you're drawing 5 million from $500,000, how long will it take you? 5,000, sorry, from $500,000, 5,000 in a year. This is 60,000. 60,000. It will take you like around 10 years to draw to fully draw down $500,000. This is because together with interest and all that it will be earning. But in often cases, someone putting $500,000 will not draw down 5,000, probably draw down 10,000. If you're drawing 10,000, I'm assuming the minimum salary wage. If you are drawing down 10,000 in a year, that is 120. 120 for you to exhaust $500,000. This will be around 5 years. You'd have exhausted the amount. Therefore, you need to look at the investment. What am I putting in, and how long can it last me? Longevity risk is now as well. Now, how long are you planning? For an income drawdown, as opposed to an annuity, that it is a lifetime decision. This is a decision that you take for every 10 years. So after 10 years, you look at it and you say, I want to probably change my investment decision, and I want to also probably change any other thing that has come on at that point. If you are drawing, if you have $500,000 and you're drawing 10,000, chances are high you will actually not probably reach to the 10 years. So is it wise to put $500,000 in an income drawdown as compared to probably putting it in an annuity? The less the amount, the safer you are with an annuity. This is because it gives you a small amount of money, but for the rest of your life. But the larger the amount, and then as well with the returns that come on, it is better to probably look at an income drawdown. Any amount from 2 million can adequately cover you in an income drawdown. And payment is normally done until the fund is exhausted. And at such a point, if you finish, let's say, the $500,000 before 10 years, the fund is exhausted and you probably have nothing else to take care of yourself from. At such a point, if the amount is little, when you're sitting down with one of our consultants, they will guide you where to put the money. Is the income drawdown the solution for you, or is the annuity the solution for you, so that you get to make the right decision? After 10 years, if you put a large amount of money, let's say 2 million or above, you get to actually live with a lump sum after 10 years. The 10 years, you can either choose to purchase, you can either choose to access the money as a lump sum, paid it out to you in cash, or you can choose to purchase an annuity, or you can as well decide to take on another 10 year on an income drawdown. We have members who after 10 years purchase an annuity. Something I told you to note when you were talking about an annuity. When I said the date of birth matters. After 10 years, you'll be a bit older. And I mentioned that the older you are, the higher your payment. This is because of mortality. At 2 million for a 50-year-old is different in terms of payment with a 60-year-old. You'll find the 60-year-old will have higher payouts than the 50-year-old. Therefore, at such a point, people actually, you look at it and say, fine, I can get in an income drawdown for the next 10 years. This is because the annuity will not give me the amount I want at the moment because I seem to be a bit younger. Then after 10 years, I'll get into an annuity and now get out of the investment risk and all the other things and now say I want to enjoy the annuity at higher rates. If you're comparing the two, an annuity provides guaranteed income for life, but buying an annuity means giving up access to potential investment growth. And once bought, the product cannot be altered. An income drawdown, on the other hand, offers investment growth potential, and there's flexibility to suit a longer-term strategy and a return of fund on death. But the fund value is exposed to investment risk. So the investment risk is normally contained because it's conservatively invested. On the downsides of an income drawdown, there's normally the volatility in investment returns. Therefore, this requires prudent asset allocation. And then there are times whereby you can outlive your money. If you start drawing immediately at 15%, that is the maximum allowed by law, chances are high that you will draw it down very fast and live longer than what you started with. Therefore, it's advisable that you start small. Don't start at the maximum 15%. Look at your needs. The consultant will get you at such a point to guide you on your needs and what you need to draw so that you actually get to have the right strategy towards it. Level of expenses higher than income. Members encouraged to do AVCs to boost retirement. Sometimes you get to see whatever you want to retire with can be a bit less than what you require in retirement. And the number one cost of retirees is normally medical, and it's advisable for you to factor it at such a point. You'll tend to see that most schemes, and as well, our income drawdown at Octagon allows you to cater for your post-retirement medical expenses, such that when you're earning your monthly pension through an income drawdown, part of it can be used or set aside towards premium payment that is normally paid once off in the next year. This is because we know medical cover is a different type of insurance whereby we say it's cash and carry. Once you fully paid for it is when you can access it. Therefore, income drawdown as well caters for post-retirement, and it also assists you towards that. Although even in an annuity, you can still plan for it and get to enjoy health cover on retirement. At such a point, is there a query before I get into post-retirement medical health?
Yes, Chrisensha. Again, I'd like to appreciate you for your comprehensive coverage and presentation. We have one of our dear members. His initial is G. He's asking, is the allowable 20,000 tax-free contribution inclusive of employer contribution, or it's only employee contribution?
Okay, the 20,000 allowable is inclusive, but the first amount to be considered is normally the employee. Let's say, for example, an employee is doing 10,000 and an employer is doing 20,000. Therefore, for the first to be considered will be the 10,000 from the employee and the first 10,000 from the employer to give a total of 20,000, and the balance of 10,000, the employer will pay tax thereon on their own end. So it's first of all caters for the two. Another scenario, if the employee is doing 30,000 monthly and the employer is doing a similar 30,000 monthly. What will happen? The first 20,000 from the employee will be considered as the tax registered fund, and then an additional 10,000 from the employee to give a total of 30,000 will go on the unregistered side. That means the employee will pay tax on it at pay level, and the other 30,000 from the employer will pay tax on it from his side. Therefore, it caters for both, but preference is given on the employee. Once the 20,000 is filled from the employee side, the employer does not enjoy any other tax advantage. But if they're probably sharing it, or maybe even they're doing 5,000 and 5,000, giving a total of 10,000, both will enjoy it. This is because until they've capped the 20,000. Is that clear?
Yeah, thank you. Thank you for that, Crescentia.
Okay. We can go into the post-retirement health challenges. I'd like to confirm that upon retirement, once a member retires, they cease being covered under their employer's medical insurance arrangements. And most of us, this is something we've often enjoyed our working years, and sometimes even we take it for granted. We never know how handy it comes at such points. We only realize now at the point of retirement when you're looking at it and you're wondering how to go about it. So on retirement, once you're no longer on the employer's cover, you need to cater for your own medical care. And unfortunately, it's upon retirement is when the health issues check in. One of the things that checks in lifestyle diseases, unfortunately, whereby now it's like you get like a life audit. How did you live your early years? Were you exercising? Were you eating the right kind of food? Because it's often at such times where we see things like diabetes kicking in, things like hypertension kicking in, and any other thing that in terms of lifestyle issues, obesity and such like. And without a medical cover, this can be quite expensive to cater for. And then as well, other things that also came up in terms of healthcare is your diet needs to change. And at the point of retirement, we often advise that we have like a session with retirees where we can guide them on their health matters at retirement so that they get to make the right decisions regarding their health. In terms of medical care, we have a pre-negotiated medical cover that caters for retirees. It's quite competitive. This is because what makes it competitive is because we have the more the people on board, the better premium rates payable are given by the insurance. Therefore, with this is normally an added benefit. One of the reasons we find necessary to have our insurance brokerage working together with the pension schemes so that members just transit from the employer's medical cover into the post-retirement medical cover, where they enjoy competitive rates because they're coming in with other members, as opposed to a member going individually into an insurance to purchase a medical cover on retirement. One of the things you will notice is that medical cover on retirement is quite expensive. This is because the insurance is sure the expenses will be incurred, and then as well going out as an individual can also be quite expensive because you are one person negotiating as one person becomes challenging as opposed to negotiating it with a number of others. Then as well, we realize most mortalities in early retirements are often health related and they can be managed with the right medical cover. Then there are also very few available medical insurance that cover the elderlies. Most of them stop at 65, but the PRMS, we have the post-retirement medical scheme we have at Octagon actually covers for life. And we tend to see that employees who outlive their life expectancy by at least 1 year average to 66%, and more than 10 years is only 29%. This can be managed with the right medical care. With that background, I I want to confirm that members can start looking at their retirement at an earlier time. Just the same way you can start looking at your retirement at 20 years, you can also start looking at your medical cover at 20 years. And it is actually RBI allowed this through a regulation, through a legal notice, and this was as well in 2018, whereby a scheme is allowed to form a sub-scheme under it, whereby members can contribute towards post-retirement medical scheme. For one, the contributions are voluntary, therefore the employee is at the discretion at whether to match or not. And then the funds are invested separately from the normal pension fund. This is because for one, medical inflation is different from any other inflation. Many years back, you could go for a particular scan at probably 1,500. These days, you go for a scan, you hear it's maybe even 5 years later, you go for a scan, you're hearing it 5,000. You can look at that inflation for the same services, same equipment, nothing new in terms of technology. And if you even compare it with probably, let's take consumer inflation, whereby a loaf of bread 5 years ago was probably a maximum of 40 shillings. And at the moment, they reach at around 50 shillings. The escalation is just 10 shillings. You compare 1,500 to 5,000, meaning medical inflation is quite higher than the normal consumer inflation. Therefore, the funds have to be invested separately in a way that they will ensure that it meets its purpose of medical cover on retirement. One, it allows members to contribute towards their healthcare treatment costs after retirement while still in active employment, meaning you can start contributing from the time you are employed, and you can continue investing as you continue. You can do additional voluntary contributions on it. The funds are invested separately, and it can be used purely on medical. Then contributions made into the scheme are invested to one of the things that invested wisely to ensure medical inflation is actually, they beat medical inflation, and they also give a return on the contributions made. Then upon retirement, the member actually can either self-insure or transfer the risk to an insurance company. Let's say you've saved up to, let's say 2 million, and at the point of premium payments on retirement, you will have your fund credit as 2 million, having saved for the duration of saving you have done. And this money will actually, you cannot transfer it to any other function. It has to be used for medical. And you can give an example, like maybe premium payment for a 50-year-old could be like 70,000. So 70,000 is drawn from the 2 million, and it's used to purchase the premium for that particular year. And the difference of it, that is 2 million less 70,000, continues being invested in the fund, and the fund continues to grow because it's not the whole amount that is transferred to the insurance. This is done on an annual basis. One of the benefits is that if you are in the income drawdown, the Octagon income drawdown called Nawiri, you actually get to do monthly payouts of it towards your medical cover, as opposed to churning out 70,000 at a go. If this is broken down on a monthly basis, it becomes a bit manageable for the member to cater for their medical cover. We have talked about pension, we have talked about medical cover, we have talked about options at retirement, and by and large, before, I just want to believe that in one way or another, you've looked and seen that retirement is actually in your hand, and there's much more you can do about it. And there are 4 ages of pension. Actually, there are actually 5, together with the 45-year-old. A 25-year-old, they are employed, you tell them, are you saving for pension? They're like, what do you mean? I am 25. I have a whole 25 years to go. Why would I think about pension at the moment? They tend to think that they are too young to think of pension. But unfortunately, age catches up, and any year lost not saving for pension actually comes back to haunt members. 35-year-old think that I'm still young, getting into many other things. And this is normally the growth stage of someone's career. And they're thinking, this is the point I need to buy a car. This is the point I need to buy a house. Where am I doing all these things for? Pension. I will start doing it once I hit 45 years. At 45 years, you probably want to start at that point. You're panicking. You have like 5 years into retirement. You're wondering, will it be sufficient? How do I go about this? And there's fear coming on, which probably sometimes affect the decision making. At 55, when you are retiring, you start regretting, saying, I wish you started 20 years ago when you're probably 35, or probably even much younger when you're 25 years. 75, sometimes it gets too late and you wish you started with your first job. And I want to believe this will not be your case today. At whatever age you are at a point to make the best decision. We say the best decision would have been made with your first job at 25 years. The next time you can make a good decision is today. Once you hear about it and you decide that retirement is in my hands, my medical care is in my hands, you cannot rely on your children as your social security. We've seen the fabric breaking over the years. Not many parents are taken care by the children. Therefore, I want to encourage you, whatever position you are at, it's not too late. With the right advice, you can always match up and you can always reach your goal. I believe when you say I am retiring at a particular, when you say you are retiring, it's not retiring at a particular age. You say you are retiring with a particular amount or a particular security. Retirement is not age-based. Retirement is security and investment-based. Therefore, it's good that we make the right decisions when we can. And I would like to share my contacts for any, if you need further guidance on your pension, if you need further guidance on your health care during retirement and what you can do about it. I believe my colleague Eve has shared an email that we can send our request to. I'll give my personal email as well. Eve, probably you can assist me by chatting, by typing it on the chat. That is crescencia.ododa@octagonafrica.com. I'll also give my personal number. If you need me to call you, or even you can call. Eve, are you in a position to write it out?
Yes, Chris.
The number is, our office number is 0709 986 000. Once you call, you can ask for Crescencia and it will be directed to me. Alternatively, you can reach me directly on 0784 851 243. Email address crescencia.ododa@octagonafrica.com. Our support email, I believe Eve can share out.
Yes, I can. Okay, before you pull your presentation down, Crescencia,
Okay, sorry.
We have a few remaining questions.
Okay.
Yes, so Franklin had asked about the additional unpaid interest. So he needs clarification and he's asking, in above case of unpaid interest, does it earn interest in subsequent months or years until paid to members?
What happens if the member had fully transited, the interest will be paid out that particular year. And why that is done administratively is to avoid interest on interest. So if you had probably retired, if it's a death situation, if it's in a migration case, all that is paid out and your account is zeroized. But if the member is deferred, meaning he has the 50% employer portion still within the fund, and the interest thereon will continue being compounded as long as the funds are in the scheme. Therefore, it will also continue earning interest. But interest alone in the fund, administratively, this is normally paid out to avoid such elements. This is because of the income declaration policy that does not allow interest on interest for members who have absolutely, let me say, left the fund.
All right, thank you. So the other question is from G. He's asking, can I be in 2 pension schemes at the same time?
Yes, you can be. There is no limit to how many pension schemes you can be. You can be in your employer's pension scheme. You can also be in an individual personal pension scheme. And it's not marked that you can be on, let me say, you cannot be in a maximum of 1 IPP. You can be in as many IPPs as you want. There's no limit to it. The only thing that is not possible, you cannot, not unless you have 2 employers, that is when you can be in 2 occupational schemes. But generally, people are often in 1 occupational scheme and a number of individual pension plans.
Okay. Okay, thank you, Crescentia, for that clarification. We are approaching the end of our session today. I would like to appreciate all our dear members for logging in and also staying with us for about 2 hours. We appreciate you and we thank you for taking the time and also dedicating those 2 hours to learn about your pension. I would like to leave you with a quote from Robert Kiyosaki. He says, financial freedom is a mental, emotional, and educational process. So I would like to applaud you all for first taking the first step of seeking financial guidance and education, and also wanting to learn about how you can plan your retirement and also how you can be able to achieve a happy retirement. Yeah, I would also like to appreciate our colleagues. Thank you, Crescentia, for the wonderful and very extensive presentation. I'm sure we have learned a lot from it, and we are going to reach through to Crescentia on the chat. You can reach her through crescentia.ododa@octagonafrica.com, or you can call our office line, which is 0709 986 0000, that is 000, or you can reach us through support@octagonafrica.com for any query of any nature that you might have. I would also like to appreciate the rest of our colleagues, George, Monica, and also Rogata, for making this session possible and successful. And I wish you a happy and restful weekend ahead. Let's meet on the next week on Friday, the same time, 10 a.m. to 11 a.m. so that you can be able to gain more insights about how to do this question of retirement and how to adequately plan for it. Thank you again, and we are free to leave the session.
Thank you.